Well, good afternoon, everybody, and welcome to this Wednesday lunchtime drive-through on a Friday. A very special Friday episode of the Wednesday lunchtime drive-through. Friday the 13th, no less. So I hope this episode is not cursed. It is Friday, May the 13th. And for those of you who have been on the drive-through for a long time, you're regulars. I told you that the month of May I was going to take off because we're meeting with many of our clients. And so it's very difficult for me to do this in the middle of the day on a Wednesday. But Fridays are a little quieter, and there's a lot going on in the market right now, as I know you are well aware. Many of the clients that we've already seen, we've talked about it. And if I'm going to see you over the next couple of weeks, we're going to talk about that too. However, I thought it was important to take some time because of the special circumstances. This is some unique territory that we're in. It's not unique that the market goes way down. That happens. Okay, if you've been investing for any length of time, you know you've been through this before. What's kind of jarring about it is that we don't see this deep of a decline very often. You know, we saw the financial crisis of 2008. We saw the coronavirus crash just 2 years ago. The market was down 38%. The market right now is down about 16%. So COVID 2 years ago was twice as worse as what we're going through right now. So I wanted to address that. But what's really important that you need to know, I think, is as bad as everything seems out there, there are key important factors that, quite frankly, I don't really see reported in the media all that much. And that's either because the media doesn't know anything about it. Okay, they just focus on the very surface stuff that will get attention-grabbing headlines. And they also want to scare the crap out of you, because the more scared and anxious you are, the more you will watch, and more likely you are to watch all those wonderful advertisements that they sell. So if you've been around me long enough, you know I'm not Pollyanna. I don't just say everything's happy and good. If I think that there's something good, there's a reason behind it. So today what we're going to share is, I call this a dose of perspective. All right. So we're not going to deny that it's difficult out there, but a dose of perspective. So let's just jump right in. Of course, if you have any questions today, you can drop those into the Q&A box or the chat box. I'm happy to answer any question that you have. All right, this is your time. So let's move on. So as I just said, it is challenging right now. It's scary. Absolutely. I'm an investor just like you. My money is invested here at ChappelWood, just like many of you who are our clients, and the rest of you who have your money invested elsewhere. We're all suffering right now. We're all hurting right now. It's the worst start for the stock market in 60 years. Inflation is killing us at the gas pump, at the grocery store. Victoria was just telling me that when she drove down to Dallas last weekend to see her mom for Mother's Day, it cost her over $60 to fill up her 16-gallon tank. Okay. We've got the war in Europe. That doesn't look like it's going to be resolved anytime soon. Interest rates are going up. Of course, they're going up as a reaction to inflation. So those two things are kind of counterbalancing each other. And then we've got shortages of goods and labor, on and on and on. And then, of course, we've got wildfires in the western United States. We've got drought. We've got declining wheat production. I was talking with my client Ron this week, and he was telling me that egg prices are going up, triple, because there's an avian flu that's going around that's decimating chicken populations. If you just look at all these headlines, you would think, well, I guess life's not worth living anymore. Let's just all pack it in and be done, right? It's tough to find bright spots when all you can see is darkness. However, it is possible to find some light. There are bright spots. You just have to know where to look. So let's make some sense of all this noise, shall we? All right. Big question on everyone's mind. Will there be a recession in 2022? A lot of what's happening in the market right now is driven by the fear of a recession. We believe that a recession is unlikely in 2022. So let that sink in for a second. We strongly believe that the risk of a recession is unlikely in 2022. Is it possible? Sure. Is it probable? No. And here's why. First of all, what is recession? Recession is defined as 2 consecutive quarters of negative economic growth. So remember, the economy and the market are not the same thing. Economic growth is our gross domestic product, our GDP. The market is a measurement of the companies that we invest in, the overall health of their earnings and growth there. The economy measures what happened in the past. The market is a measurement of what we believe about the future. That's why you can have economic growth but market decline at the same time, and vice versa, because they're measuring different things. 70% of our nation's economic activity, or our gross domestic product, is driven by consumer spending. So us spending money, 70% of it is that. And consumer spending is comprised of 2 categories. There are goods like groceries and Home Depot and Lowe's and clothing and stuff like that. And then there are services, going out to eat, getting your car worked on, going to the dry cleaners, getting your hair done, getting your shoes shined, getting on an airplane, taking a cruise. Those are services, all right? What you need to remember is this, okay? What is a recession? It's a decline in economic activity. Recessions are very unlikely when demand and consumer spending are very strong, okay? So remember that. Recessions are very unlikely when demand and consumer spending are very strong. So guess what? Consumer spending is very, very strong right now. Demand is through the roof. Consumer spending increased 2.7% in the first quarter of 2022. You might ask, how is that possible, Damon? Inflation is so high, we're spending so much more for the things we need. People don't seem to care. Well, they care, but they're absorbing it. We're not curbing our lifestyles. In fact, if anything, we're living more. People are getting on airplanes more, especially now that mask mandates are gone, at least on the airplanes. Unemployment is at its lowest rate in 50 years. Wages and household balance sheets are strong. Wages are going up. Spending on services is getting even stronger. For the longest time, the rise in consumer spending that we saw was on the goods side of things, but goods only account for 1/3 of consumer spending. Services, which is now the fastest growing part of consumer spending, accounts for 2/3 of consumer spending. So if consumer spending was strong while goods were strong, it's going to be even stronger as services, which were the ones decimated by COVID. All those 26 million jobs we lost, most of them were on the service side. We didn't stop going and buying groceries. We just now bought them online instead of going to the grocery store. Where did we stop spending our monies? In restaurants, in movie theaters, all the things that required us to be closer than 6 feet, right? Those are now the sectors that are starting to grow even more. Now, inflation is still high, but if you saw the inflation report this week, it did come down slightly, very slightly in April, but it did come down. And so far, even with higher prices, consumers are spending a lot of money. 70% of our economic growth is driven by consumer spending. That is the biggest factor, and it's really, really strong right now. Now, what is the greatest risk of recession? It's interest rates. Okay, the greater risk here is not that consumer spending will go down. The greater risk is that the Federal Reserve will raise interest rates too high. Because why is the Fed raising rates? Because inflation is so high. The Federal Reserve has 2 key mandates and another third one that was added on. There are 2 key mandates: keep unemployment low and keep inflation in check. Unemployment is really low right now. In fact, there's a labor shortage. There are far more jobs available than people able and willing to work them. But right now they're trying to fight back against inflation. How do they do that? By raising interest rates. What does rising interest rates do? Raising interest rates makes the flow of money less. It's more expensive to borrow money. Companies have to pay more on their bonds. So what it does is it pushes down the overall level of demand low enough so that we can get prices under control. Right now, prices are so high because demand is so high and supply is low. You remember your economics class, right? Supply and demand. Supply is low, demand is high, prices go up. However, 8 of the last 10 recessions that we've had have been triggered because the Federal Reserve raises interest rates too high. They get to a certain point, which is fine, but then they go beyond that point. And the Federal Reserve knows that. But the question that we ask is, how likely will there be a recession in 2022? While a recession is possible, the risk of it is far out in the future at this point. That's what we believe. And it isn't just because, well, that's just what we want to believe. There are reasons, tangible evidence to suggest that our economy is very, very strong right now. And recessions do not. Strong economy and recessions are absolutely opposite of one another. They're mutually exclusive. Okay. Recessions happen when economic output is falling. That's not happening right now. Okay. So the answer to the question, are we going to see a recession this year? We don't believe so. Is it possible to see a recession next year? That's more likely. Okay. But we're talking about this year. Now, next question. The economic report. Every quarter, at the end of the quarter, really the beginning of the next quarter, we get a report on last quarter's economic output. And guess what? The economy shrank in the first quarter. Economic growth was negative in the first quarter. And it shrank by 1.4%. So now you're sitting there thinking, now wait a second, Damon. You just said 2 consecutive quarters of negative economic growth equals a recession. Well, if the first quarter was negative, and if the second quarter ends up negative, isn't that a recession? I mean, we're halfway to a recession right now, right? How can you possibly say that a recession is unlikely this year if we're already halfway there? That's because you need to apply some context to that report. All right. The first signal, the very first place you should look to determine whether or not a recession is imminent, is a sharp decline in consumer demand. What did we just talk about? Demand is extremely high. In fact, we had a negative economic report, meaning our own gross domestic product contracted by 1.4%, not because consumer demand was too low. It actually was negative because consumer demand is too high. GDP measures our domestic production, and domestic production in the first quarter was not able to keep up with the consumer demand. We did not produce enough here in the United States. In our entire freaking country, we couldn't produce enough goods and services, well, goods mostly, that's what we're importing, to satisfy consumer demand. So what did we have to do? We had to import more. And our trade imbalance grew mostly with China and many of the countries that we import stuff. When you take a look at our gross domestic product, imports are not included in that. In fact, they detract from it. So when you look at the entire output, you have to subtract the value of imports. Imports are not counted in our gross domestic product. As a result, it goes against our total GDP. However, the money that consumers are spending on those is still a function of demand. That means demand is still very high. If you look at that negative economic report for the first quarter, it is misleading. If you don't dig into it a little bit more, why was it negative? Don't just tell me that it was negative. Tell me why it was negative. Why it was negative was because our own production couldn't keep up. That is not the sign of a contracting, receding economy, my friends. That is a sign of an economy that we need to ramp up production, right? There's so much demand there. People are willing to spend so much money. We couldn't do it all. Increased demand is why inflation is so high. If demand were low, well, then we would see prices starting to come down. We're not seeing that, at least not as quickly as we want. And if we saw that, if we truly saw a decline in consumer demand, then that would actually lead to a recession. So my advice to you is when you're looking at any financial report, whether it's your own quarterly statement or the financial report or any report about finances, you have to consider the fundamentals. And one of the fundamental forces that supports our economy is consumer demand and consumer spending. Those things are very strong right now, which is a good sign for the future of our economy, especially this year, and by extension, the market. Because if we're spending a lot more money, what does that mean for the earnings of the companies that you and I are invested in? They're going up. And when earnings go up, profits go up. And when profits go up, dividends go up, hiring goes up, salaries go up, stock prices go up. So we still don't believe we're going to enter into a recession, even though the first quarter GDP report was negative. It was negative, not because of declining demand, which is the actual signal of a recession. It's because we couldn't keep up with demand. Next. So if that's all true, if demand is very strong, all of these economic signals are very positive and strong, why is the market doing what it's doing? Why are we seeing such a major decline? Okay, I mean, we get why we saw a major decline in the market in 2020. The market was down 38% by April, May. Well, it's because COVID shut our economy down. Now, that was a true recession because consumer demand was zero. It was nothing. Nobody was buying anything. We couldn't do anything. So that led to a big sell-off. Of course, the market rebounded then. But you'll note, especially if you are a client of ChappelWood Financial, we didn't go all to cash when the market was down 38%. Well, right now, the market's down 16%. We're not going all to cash right now either. We didn't panic then. We're not panicking now. But a lot of people are. Why? Mostly fear over a recession. Okay, that's really what's driving it. The interest rates and inflation and all this other stuff, those are symptoms of a broader fear. Those are expressions, symptomatic expressions of the broader fear, and the broader fear is a fear of a recession. The current market sell-off is largely being driven by emotion, and namely that emotion is fear over an impending recession. Now, here's something else to know about recessions. I've been saying a recession is unlikely this year. Recession is more likely next year. Why? Recessions don't happen immediately. They don't happen overnight. If you look back through history, recessions historically begin anywhere from 12 to 15 months from the time that the Federal Reserve begins raising interest rates. Now, the Fed started raising rates in March of 2022. That would mean if that pattern follows, and if we are going to have a recession, it's more likely to start sometime in the end to middle part, end of first quarter, middle part of second quarter in 2023. I'm not saying we are going to have a recession, but if we are going to have one, it's more likely that it's going to be next year rather than this year. Okay. However, most people don't understand how our economy works. They don't understand that mechanic. And as a result, they assume everything happens immediately. And the way we feel right now is how we assume the world really is. If we feel this way, then that must be the way the world is, right? So I'm going to get out because the market's going into recession. The market is pricing in this expectation. That's why we see the market down 16% year to date. However, there's one key aspect of the stock market that is fueling this sell-off, and it's a key aspect of the market that is always with us. It's always there in the background. I hardly ever hear it get reported on, and there's a good chance you don't even think anything about it. But now you're going to know what it is. Are you ready? There's a key factor missing, a key element missing from the recipe that helps to drive the market, and that is stock buybacks. The biggest purchasers of stocks are not you and me. They are the companies that issue those shares. Companies are constantly buying back their shares of stock. Typically, they're buying them back when they believe that the overall market is undervaluing their shares. We're seeing a big sell-off right now. Truth be told, the market's oversold. I mean, if you've got some cash right now, this is not a time to panic. This is a time to go bargain hunting. Yeah, I mean, you got the entire S&P 500 in the discount rack, relatively, right? I mean, Tesla is still $800 a share, but that's a lot less than what it was. Okay, everything's down, especially in the technology side. The market was up 28% in 2021. All right, of the S&P 500. And I've said many times here and privately as with our clients, the S&P 500 does not share its growth evenly among all 500 stocks. It's a market capitalization weighted index. The bigger the company, the more influence that company's stock has on the performance of the overall index. It is not even. Last year, there were 10 companies that accounted for 20% of that 28%. 10 companies, 2% of the entire S&P 500. Most of those companies were tech. Facebook, Google, Amazon, Netflix, Microsoft, Apple. Big names, right? 490 stocks accounted for the other 8%. Now this year, we're down almost, we haven't quite hit 20%, which is defined as a bear market. Haven't gotten there. We flirted with it yesterday. Yesterday being, what was it, May, what is today's date? I don't have it here. May 13th. So May 12th, 2022, the market got down as low as minus 19%. We were close to a bear market. Not surprisingly, the biggest loser this year, technology. That's why the NASDAQ is getting hammered. The NASDAQ index tracks almost exclusively technology. That's why that index is terrible this year relative to the S&P, the Russell 3000, the Dow, that sort of thing. Anyway, one of the big issues right now is that there are no stock buybacks happening right now. Why? Because it's earnings reporting season. And most companies black themselves out from stock buybacks during earnings reporting season, which is happening, like I said, right now. And generally that buyback or that blackout period is about a month. Okay, they black themselves out about 2 weeks before they report on earnings, and then maybe another 2 weeks after that. Why? Because when they buy back their shares, they can manipulate significantly the value of the market. They do this all the time, and it's perfectly legal. Why do they do this? Well, to maybe boost the value of their shares, maybe to return equity back or return value back to their shareholders. This is what you're seeing a lot in the energy industry right now. Oil prices are very high right now. And a lot of people would think, well, then why aren't the oil companies out there just pumping out a whole bunch more oil? Wouldn't they earn a lot more money? Many oil CEOs, they're not concerned about drill, baby, drill. What they're concerned about, if prices are high, let's not ramp up production, because what does more supply do? It brings prices down. What they're focused on right now is what they have not been able to do for many years because oil prices were so low. Return value back to their shareholders in the form of higher dividends, higher stock prices. If they ramp up production and depress the value of oil even more, that's going to depress their stock prices. Right now, their investors are seeing returns they've not seen in a long, long time. There's not a lot of incentive to pump more oil. Just because you and I are paying more at the gas pump, that's not what they're focused on. They're focused on their shareholders. So the biggest customer of shares of stock are not in the market right now. And now you've got all these people dumping shares. Guess what else? Hedge funds. Hedge funds make a lot of money by speculating on stocks. Okay. Now you've got a lot of hedge funds that were speculating on a broad increase in the market. They got that. Now they're dumping their shares. Billions of dollars in stock being dumped back into the market. There are no companies, or few companies right now buying back those shares. So all these shares get dumped in the market and the biggest buyer of them is gone. They're not participating right now. 80% of S&P 500 companies right now are reporting stronger than expected first quarter earnings. It's good for them and it's good for your portfolio. It will get expressed eventually. When the blackout ends, expect stock buybacks to provide a boost to the market. It almost always happens, especially when the market's way down. Okay. I've not heard anybody reporting about this. It's not that I'm the only one paying attention to it. I just don't hear it reported widely in the media. But it's a huge part of the market. All right. Now, in the last couple of weeks, I have been getting a ton of questions about what are I bonds. I've been watching the news and I've been listening to the radio. I keep hearing about these special bonds called I bonds. What are these? And so I thought, okay, this is a great time to kind of talk about this. And specifically, I bonds they've gained popularity as a hedge against inflation. All right. So I for inflation, I guess. What are they? Well, investors are looking for inflation busters. When inflation rises, the stock market is usually where investors go, but obviously we've seen a lot of volatility. And so the market is not nearly as attractive as it has been. You've got assets like gold, real estate, commodities. Those have usually traditionally been hedges against inflation. Gold prices have increased 8%. They increased 8% in the first quarter. Gold demand increased 34% in the first quarter. But something else that's in demand are government bonds. We've seen the value of government treasuries. The 10-year treasury note, which is kind of that litmus test for if it's rising, people are going to safety. That's usually a harbinger for the stock market that it's coming down. When they talk about the yield curve inverting, they're talking about government bonds, things like that. One type of bond, the Series I bond, has risen in popularity. So what is it? It's a government bond. It's issued by the United States government. Its interest payment is a combination of a fixed rate plus an inflation rate that is adjusted every 6 months or semi-annually. So right now you can actually go out and buy Series I bonds for the issue date of May through October of this year, and they are paying 9.62%. Not too shabby, right? And it is keeping up. It's beating the current rate of inflation, which is just over 8%. Now you can go purchase up to $15,000 per year of Series I bonds, $10,000 electronically, and then $5,000 in actual paper bonds that they will mail to you. These bonds have a 30-year maturity. You have to hold on to them for at least 1 year. After you've held on to them for at least 12 months, then you can sell them. But the thing you need to know is that if you sell these bonds before you've owned them for at least 5 years, you are going to sacrifice 3 months of interest payments. All right, so there are a few strings attached to these things. And if you want to buy any bond, you can actually go to treasurydirect.gov. It's a government website. You can set up an account and you can actually go out and buy Series I bonds, Series EE bonds, any bonds that the federal government issues. Now, this sounds great right now, right? Even something like TIPS or Treasury Inflation Protected Securities. All of these kinds of inflation adjusted assets are very popular right now because inflation is so high. These kinds of assets have greater value when inflation is really high. But keep in mind, Series I bonds, that inflation adjustment gets redone every 6 months. So if inflation comes way down, well, it becomes less valuable. It pays less. The fixed rate's always going to stay the same, but it's really low. The real value is if inflation stays high. So if you're going to invest in these, I'm going to tell you the same thing I tell you about any investment. Number one, make sure it meets with your overall appetite for risk. But if you're going to go for some of these hedging type strategies, it's probably a good idea to limit it to a small percentage, maybe 2, 3, 4% of your total. You know, if you're going to have bonds, probably better off just focusing on good investment grade or high yield bonds. And then you change that bond portfolio as interest rates go up. Because right now, bond value is going down because interest rates are going up. It's an inverse relationship. So that is what I wanted to share with you today. Things are not as bad as the media might have you believe. Are they wonderful? No, they're not. And I've met with many of you in the last 2 weeks, and 2 more weeks, I'm going to meet with many more of our clients. And I know you've already seen your first quarter statement, and it wasn't good. And it's gotten even worse since then. And it's painful. Trust me, as your advisor, I don't enjoy those meetings. I mean, I enjoy seeing you, but I don't enjoy sitting there looking at these statements. But you don't have us as your advisor so that we can put on a dog and pony show for you. Sometimes the best work that we do is right now, showing you that while things look bad, there are many, many things that we're paying attention to that are underlying your portfolio. And those of you who are not part of the ChappelWood family, underlying your portfolio, your 401k. There are many forces at work that are lifting up the market while there are forces pushing down on it. And it turns out that the forces lifting up on the economy and the market are fundamental forces that are always there and that over time lead to the economy and the market going up. Many of the forces pushing down on it right now are short-term forces that come in, they punch you in the face really hard, and you get a black eye, but eventually the bruise subsides. And what's left is the fundamental nature of the market and the economy. Things are not as bad as they might seem. And I hope that this presentation today has shown you that. And that this isn't just because we think so, it's because there are tangible, real numbers, real concrete evidence to support the way we feel. Now, can we change our minds? Sure we can. But our minds aren't going to change just because tomorrow we feel like it. It's going to change because the evidence would suggest that. So I want to thank you so much for being on the Wednesday drive-through with us today. I hope that you enjoyed this presentation. I hope that you feel better. I hope that you see there is hope, that there's reason for optimism. We just have to get through this. We've gotten through it before. We're going to get through it again. And there are reasons for good optimism and hope. So thank you so much. Keep your seatbelts fastened. Keep your arms and legs inside the vehicle at all times. And when you have any questions, give us a call, 405-348-0909. If you're a client, you know where to find me. I'm always here. And if you are not yet a member of the ChappelWood family, but you need some help, you can take your phone, scan it with your camera app, go there, and you can schedule a 30-minute phone call with Shelly, and we'll see how we can help you. You're very welcome. Thanks, Ellen. Thanks, Kathy. We appreciate that very much. Thank you to all of you. Have a wonderful weekend. Stay safe, stay strong, and stay focused on the fundamentals. That's what really drives the market and the economy. We'll see you next time. Bye-bye.